The Liquidity Flood Strategy, Government Responses to the 2026 Market Crisis, Understanding the Policy Playbook. When markets crashed in 2026, governments faced an immediate choice: allow deflationary collapse or flood the system with liquidity. This wasn't a new dilemma. Central banks and governments had faced similar choices in 2008 and 2020. But the scale in 2026 was unprecedented, and the strategies deployed had consequences that are still unfolding. Understanding what governments did, why they did it, how it affected markets, and what it means for anyone holding assets or making financial decisions is critical. The liquidity flood wasn't just policy. It was a transformation of how money, markets, and value itself function in the post-crash world. Let me show you exactly what the liquidity flood strategy involved, why governments believed it would work, how markets actually responded, and what the lasting implications are for investors, savers, and anyone trying to preserve wealth in the aftermath. The 2026 crash created an immediate liquidity crisis. Credit markets froze. Banks stopped lending. Companies couldn't access capital. Asset prices were collapsing. The velocity of money, how fast money moves through the economy, was falling rapidly. Deflationary spiral was the primary fear. Governments and central banks responded with what they knew: monetary and fiscal expansion. The Federal Reserve cut rates from 5.5% to near zero in 3 months. Other central banks followed, but rate cuts alone weren't enough. The problem wasn't just expensive borrowing, it was unavailable borrowing. Central banks launched quantitative easing programs that dwarfed previous efforts. The Fed announced $4 trillion in asset purchases, treasury bonds, mortgage-backed securities, even corporate bonds. The European Central Bank announced $3 trillion in purchases. The Bank of Japan expanded its balance sheet by $200 trillion. The Bank of England added $500 billion in QE. The scale was staggering. In 2008, the Fed's QE totaled about $3.5 trillion over several years. In 2026, they announced more than that in the first quarter alone. The money creation was orders of magnitude larger than previous crisis responses. Fiscal policy matched the monetary expansion. The U.S. government passed emergency spending packages totaling $3 trillion in direct support. Unemployment benefits, business loans, infrastructure spending, direct payments to households. European governments announced similar programs scaled to their economies. Japan, China, and other major economies deployed massive fiscal stimulus. The combined global fiscal and monetary response exceeded $15–20 trillion in the first 6 months. Governments were flooding the system with liquidity by any means possible. The goal was to prevent deflationary collapse, support asset prices, maintain confidence, and restart economic activity. The strategy was based on lessons from 2008 and 2020. In those crises, aggressive monetary and fiscal response had worked. Markets stabilized, economies recovered. The playbook was clear: overwhelming force, deployed quickly, maintains confidence, and prevents worst outcomes. Governments applied the same playbook in 2026, just bigger. The theory behind the liquidity flood was straightforward. When credit markets freeze and asset prices collapse, the economy faces a deflationary spiral. Falling prices increase real debt burdens. Higher debt burdens cause more defaults. More defaults cause more price declines. The spiral feeds on itself. Breaking the spiral requires injecting massive liquidity. Central banks buy assets, putting cash into the financial system. This cash provides liquidity to banks and investors. With more cash available, credit can flow. Asset prices stabilize as buyers emerge. Confidence returns as prices stop falling. Fiscal spending adds direct demand to the economy. Government buys goods and services, pays workers, supports businesses. This spending prevents demand from collapsing completely. It maintains employment, keeps businesses operating, prevents the real economy from contracting as much as it otherwise would. The combination of monetary and fiscal stimulus was meant to create a floor under the economy. Stop the free fall, provide breathing room, allow time for adjustment and recovery. The liquidity flood buys time for the real economy to heal. The strategy also relied on wealth effects. When asset prices rise due to central bank purchases, asset holders feel richer. They consume more. This additional consumption drives economic activity. Rising asset prices also improve corporate balance sheets, making them more creditworthy. Credit flows return, investment increases. The confidence channel was critical. If markets believe central banks will support asset prices, they stop selling in panic. Buyers emerge. Markets stabilize not just from direct purchases, but from the expectation of support. The central bank put the belief that authorities won't let markets fall too far, creates self-fulfilling stability. Inflation was considered a feature, not a bug. Some inflation would reduce real debt burdens, make existing debts easier to pay, encourage spending rather than hoarding. Modest inflation was desirable to fight deflation. The risk of excess inflation was considered manageable through eventual policy normalization. This was the theory. Massive liquidity injection would break the deflationary spiral, stabilize asset prices, restore confidence, maintain demand, create helpful inflation, and buy time for recovery. It had worked before. The assumption was it would work again. The market response to the liquidity flood was complex and not entirely what policymakers expected. Some assets responded as predicted, others didn't. The effects were uneven and created new distortions. Treasury bonds rallied initially as the Fed bought trillions. Yields fell, prices rose. Holders of treasuries saw gains. This was expected and desired. Lower yields meant lower borrowing costs for government and private sector. The treasury market stabilized quickly, but the rally was temporary. As inflation emerged from the money printing and supply chain disruptions, bondholders demanded higher yields to compensate. By mid-2026, yields were rising despite Fed purchases. The Fed was fighting the market. They bought bonds to push yields down. Markets sold bonds pushing yields up. The Fed was losing the fight. Stock markets initially surged on liquidity news. The first QE announcements sparked rallies. Major indexes rose 20-30% from lows. This seemed like success, asset prices stabilizing, wealth effects engaging. But the rallies were short-lived. Corporate earnings were collapsing, revenues falling, margins compressing. The fundamentals didn't support valuations. As earnings reports came in showing the real economic damage, stocks fell again. The liquidity provided a temporary boost, but couldn't overcome deteriorating fundamentals. Real estate markets fragmented. Some segments stabilized with mortgage purchase programs. Other segments continued falling as unemployment rose and people couldn't pay mortgages. The liquidity helped at the margins, but didn't prevent overall real estate price declines of 30-40%. Corporate bond markets remained dysfunctional despite Fed purchases. High-quality corporate bonds traded okay. High-yield bonds remained distressed. Many companies were fundamentally insolvent. Fed purchases of investment-grade bonds didn't help junk bonds. The credit market remained bifurcated. Commodity markets responded chaotically. Energy prices initially fell with demand destruction, then spiked as supply disruptions hit. Agricultural commodities rose with weather disruptions and input cost increases. Industrial metals fell with manufacturing decline. The liquidity flood affected commodities indirectly through inflation and currency effects. Currency markets saw the dollar initially strengthen as safe haven, then weaken as money printing became obvious. Other currencies had similar patterns. Currency volatility was extreme. Exchange rates gyrated daily. The forex market became nearly untradeable for periods. The gold market exploded. As fiat currency credibility declined, gold surged from $2,100 per ounce pre-crash to over $3,500 by late 2026. Silver followed. Precious metals were the clear winners from the liquidity flood. They reflected loss of confidence in paper money. Cryptocurrency markets were volatile but trending up. Bitcoin and other major cryptocurrencies saw renewed interest as alternative to fiat money. Some cryptocurrencies failed, others thrived. The overall trend was toward legitimacy and adoption as the monetary system's problems became undeniable. The liquidity flood created consequences that policymakers hadn't fully anticipated or prepared for. Some consequences emerged immediately, others took months to become apparent. Inflation surged faster than expected. The combination of money printing and supply disruptions created rapid price increases. Food inflation hit 20-30% year over year. Energy prices spiked. Housing costs remained high despite falling prices because mortgage availability collapsed. The inflation was broad and persistent. The inflation wasn't the good kind that reduces debt burdens while maintaining purchasing power. It was the bad kind, where prices rise faster than incomes. Real wages fell. Purchasing power declined. People were poorer despite nominal income stability. The inflation hurt more than it helped. Asset inequality exploded. The liquidity flood inflated financial assets. People with stocks, bonds, real estate, gold, they saw asset values supported or increased. People without assets, living paycheck to paycheck, saw purchasing power destroyed by inflation. Wealth inequality reached levels not seen since the 1920s. This created political instability. The perception that governments were bailing out the wealthy while the poor suffered wasn't entirely wrong. Asset holders were being protected while wage earners were being impoverished. The political backlash was severe and contributed to extremist electoral victories globally. Moral hazard became entrenched. Companies that had taken excessive risks were being bailed out. Banks that had made bad loans were being supported. Investors who had overpaid for assets were being rescued. The lesson was clear. Take big risks because authorities will prevent big losses. This guarantees future crises. Zombie companies proliferated. Firms that should have failed were kept alive by cheap credit and direct support. They couldn't invest or grow, but they couldn't be allowed to fail. They absorbed resources without producing value. The economy became less dynamic and productive. Savings were destroyed. Interest rates near zero meant savers earned nothing. Inflation meant cash lost value. The traditional safe path, save money, earn interest, build wealth slowly, became impossible. Savers were forced into risky assets or watched their wealth erode. The social contract around saving was broken. Currency debasement became obvious. When central banks create trillions in new money, each existing unit becomes worth less. The purchasing power of money declined. People noticed. Confidence in fiat currency decreased. Alternative money forms, crypto, gold, even barter, became more common. Capital misallocation increased. When money is artificially cheap, investment goes to wrong places. Projects that shouldn't be funded get funded. Productive investments are crowded out by speculative ones. The economy becomes less efficient. Long-term growth potential decreases even as short-term activity is supported. Government debt became unsustainable. The fiscal spending was financed by borrowing. Debt to GDP ratios exploded on 30%, 50%, levels historically associated with default or crisis. Even with central banks buying the debt, markets became nervous. The sustainability question loomed larger as months passed. By late 2026, it was clear the liquidity flood hadn't achieved its primary goals. The economy hadn't recovered. Asset prices remained depressed overall. Credit wasn't flowing normally. Confidence hadn't returned. Why did the strategy fail? The problems were structural, not cyclical. The liquidity flood addresses cyclical problems, temporary demand shortfalls that resolve once confidence returns. But 2026 involved structural breaks. Supply capacity destroyed energy constraints. Broken supply chains, these couldn't be solved with liquidity. You can't print oil. You can't print semiconductors. You can't print food. When real resources are constrained, creating more money doesn't create more resources. It just creates inflation. The liquidity flood couldn't address the real physical constraints the economy faced. The debt overhang was too large. Many borrowers were fundamentally insolvent. They owed more than they could pay even with zero interest rates. Providing them more cheap credit just added to unpayable debt. The solution required debt write-offs, which were politically impossible. So the debt burden remained. The trust was already broken. The liquidity flood strategy depends on confidence. If people believe the central bank can stabilize markets, they stop panicking. But in 2026, trust was already gone. People knew the central bank couldn't fix structural problems. The confidence channel didn't work because confidence was too damaged. The international coordination failed. In 2008 and 2020, major central banks coordinated. Swap lines provided dollars globally. Policies were synchronized. In 2026, coordination was minimal. Geopolitical tensions prevented cooperation. Each country acted unilaterally. This reduced effectiveness of liquidity provision. The transmission mechanisms were broken. Normally, central bank liquidity reaches the real economy through banks lending. But banks weren't lending because borrowers weren't creditworthy. The liquidity sat in bank reserves. It didn't transmit to businesses and households. The money creation didn't circulate. The velocity of money collapsed. Even with massive money supply increases, if money doesn't circulate, it doesn't affect prices or activity much. People and businesses hoarded cash. They didn't spend or invest. The velocity decline partially offset the money supply increase. The net effect was smaller than intended. The political environment prevented sustained support. Public backlash against bailouts was intense. Governments faced pressure to stop supporting asset prices and start helping workers directly. But direct support required different policies. The political sustainability of the liquidity flood was limited. As it became clear the liquidity flood wasn't working as intended, markets adapted. Investors changed strategies, asset allocations shifted. New patterns emerged. Flight to real assets accelerated. Investors moved from financial assets to physical assets, real estate and quality locations, farmland, precious metals, commodities, art, collectibles, anything tangible that couldn't be printed. The premium for real assets over financial assets increased dramatically. Gold and silver became portfolio staples. Previously, niche holdings became mainstream. 10-20% portfolio allocations to precious metals became common among sophisticated investors. Gold wasn't just inflation hedge. It was currency hedge, trust hedge. System hedge. Cryptocurrency adoption increased among certain demographics. Younger investors especially embraced crypto as alternative to failing fiat system. Bitcoin, Ethereum, and other major cryptos became legitimate portfolio components. Not speculation, serious long-term holdings. Dividend stocks and income-generating assets were prioritized. In an environment where bonds yielded nothing and cash was losing value, assets that produced income became valuable. High dividend stocks, REITs, preferred shares, anything paying reliable cash flow commanded premiums. Geographic diversification became essential. Holding everything in one currency or country was recognized as dangerous. Multi-currency portfolios, foreign real estate, international businesses. Spreading exposure across jurisdictions and currencies became risk management necessity. Barbell strategies emerged, combining very safe and very risky assets while avoiding the middle. Hold some gold and treasury bills for safety. Hold some venture capital and crypto for upside. Avoid corporate bonds and dividend stocks that offered neither safety nor growth potential. The middle was death. Self-custody and direct ownership increased. Counterparty risk became real concern. Holding assets through intermediaries, brokers, banks, funds, carried risk that the intermediary might fail. Direct ownership of physical gold, self-custody of crypto, owned real estate over REITs. Removing intermediaries reduced risk. Shorter time horizons prevailed. Buy and hold strategies felt dangerous when the system was unstable. More trading, more tactical allocation, less strategic allocation. The ability to move quickly became more valuable than having a long-term plan. These adaptations reflected recognition that the liquidity flood hadn't fixed the system. It had just changed what worked. Investors who adapted survived. Those who didn't lost wealth. The liquidity flood of 2026 changed markets permanently. Even if policies normalize eventually, certain changes are irreversible. Price discovery is impaired permanently. When central banks are major buyers in multiple markets, prices don't reflect pure supply and demand. They reflect policy decisions. True price discovery, where markets find clearing prices, is damaged. Markets are partially administered, not fully free. Volatility is structurally higher. The system is more fragile post-crash. Policy uncertainty is greater. Geopolitical tensions are higher. Markets swing wildly on news. The low volatility regime of the 2010s is gone. High volatility is the new normal. Correlations between assets have broken down. Traditional diversification strategies based on asset class correlations don't work as before. Everything became correlated during the crash. Post-crash, the relationships are unstable. Portfolio construction is more difficult. Liquidity is permanently impaired in many markets. Bid-ask spreads are wider. Market depth is shallower. Large trades move prices significantly. The ease of trading that characterized pre-crash markets is gone. Markets are less liquid across the board. Market structure has fragmented. Regional markets are more isolated. Cross-border investment is restricted. Global markets have split into regional markets with limited connection. This creates arbitrage opportunities, but also prevents efficient capital allocation. Risk-free assets no longer exist. Government bonds were considered risk-free. No longer. Sovereign default risk is real. Currency risk is real. Inflation risk is real. The concept of a truly safe asset has disappeared. Everything carries risk now. Passive investing has declined. Index funds and ETFs dominated pre-crash investing. Post-crash, with price discovery impaired and volatility high, passive strategies perform worse. Active management is necessary. Stock picking matters again. The passive investing era has ended. Alternative assets have mainstreamed. Crypto, gold, private equity, real estate, commodities. These were alternative to traditional stocks and bonds. Now they're essential portfolio components. The 60-40 stock-bond portfolio is dead. Portfolios are more diverse and complex. For anyone trying to preserve and grow wealth in the post-flood environment, the implications are clear and challenging. Cash is trash. Holding fiat currency means watching purchasing power erode. Some cash for liquidity is necessary, but large cash holdings are wealth destruction. The era of holding savings accounts is over. Cash must be deployed into assets. Traditional safe investments are dangerous. Government bonds at negative real yields destroy wealth slowly. Corporate bonds carry default risk without compensating yield. The investments considered safe historically are losing propositions now. Diversification is more important and more difficult. The old simple diversification of stocks, bonds, cash doesn't work. Real diversification requires multiple asset classes, multiple currencies, multiple geographies, multiple strategies. It's complex and requires constant attention. Inflation protection is mandatory. Every portfolio needs assets that protect against inflation. Real estate, commodities, precious metals, inflation-indexed bonds if available. Without inflation protection, wealth erodes invisibly. Understanding monetary policy is essential. Policy decisions move markets more than fundamentals. Following central bank actions, understanding policy intentions, anticipating policy changes, these are necessary skills. Monetary policy literacy is no longer optional. Tax efficiency matters more. With wealth being destroyed by inflation and policy, preserving what's left requires tax efficiency. Using tax-advantaged accounts, harvesting losses, managing capital gains. Tax strategy is wealth preservation strategy. Continuous learning is required. The market environment changes constantly. Yesterday's strategies stop working. Staying informed, adapting quickly, being willing to change approach. Intellectual flexibility determines success. Risk management is everything. The downside risk in markets is larger than upside potential in many cases. Protecting against losses matters more than capturing gains. Position sizing, stop losses. Hedging, risk management is primary. Returns are secondary. The liquidity flood's failure created political consequences that are still unfolding and will shape the future. Public anger at financial policy is intense and lasting. People saw governments create trillions for banks and corporations, while ordinary citizens struggled. The bailout mentality created permanent resentment. This resentment fuels populism and extremism. Trust in central banks is destroyed. The institutions that claim technical expertise and political independence are seen as captured by financial elites. Their credibility won't return easily or quickly. Monetary policy effectiveness is reduced when no one believes central bank statements. Generational wealth transfer accelerated. Older generations holding assets saw wealth preserved or increased by liquidity flood. Younger generations with no assets saw their purchasing power destroyed. The wealth gap between generations widened dramatically. This creates social tension. Financial literacy became necessity, not luxury. People who didn't understand markets and money got destroyed. People who understood adapted. The education system doesn't teach practical financial skills, but survival requires them. Self-education in finance is essential. Alternative systems gain legitimacy. When the official system fails, alternatives emerge. Cryptocurrency, local currencies, barter networks, mutual aid. These alternatives now have permanent place. The monetary monopoly has been broken permanently. Class consciousness increased. The awareness that policy benefits some classes over others became undeniable. Working class sees clearly they subsidize wealthy. This awareness is politicizing and radicalizing. Class conflict is returning after decades of dormancy. The liquidity flood strategy deployed in 2026 was the largest monetary and fiscal expansion in history. It was meant to prevent deflationary collapse, stabilize markets, restore confidence, and buy time for recovery. It achieved some goals. It prevented immediate systemic collapse. Some asset prices were supported temporarily. Complete credit freeze was avoided. The absolute worst-case scenario didn't happen. But it failed in its primary mission. The economy didn't recover. Structural problems weren't solved. New problems were created. Inflation surged. Inequality exploded. Trust was destroyed. The consequences of the flood may ultimately be worse than the problems it was meant to solve. For anyone trying to preserve wealth and navigate markets, understanding the liquidity flood is essential. It changed how markets work. It changed what assets matter. It changed the risks and opportunities. Operating with pre-flood assumptions guarantees losses. The flood revealed that monetary policy has limits. You can create money, but you can't create real resources. You can support asset prices temporarily, but can't change fundamentals permanently. You can delay problems, but can't eliminate structural weaknesses. Markets have adapted to the flood. Investors are adapting. The adaptation is ongoing and will continue for years. Those who understand the new dynamics will survive and potentially thrive. Those who don't will watch their wealth disappear in the currents created by the flood. This is the reality of the post-flood world. Not what was intended, not what was promised, but what exists. Understanding it objectively, without illusions, is the first step to navigating it successfully.